the United States, though, through this tightening cycle. And I think that's partly related to the stronger productivity growth I mentioned in the United States. And it may also be related to the fact that monetary policy may be having a bigger impact on households in Canada because of the different structure of our mortgage market. More of our mortgages have reset in Canada, so more people are feeling those higher interest rates. And that has restrained household spending more in Canada. In each of our countries, I do want to underline that, we gear our policy decisions to our domestic monetary policy mandates. And in Canada, we have our own currency, we have a flexible exchange rate, so we can run our own monetary policy. So simply put, we don't have to do what the Fed does. We can do what Canada needs. I do think, though, we're looking at the same things and asking ourselves the same questions. I think we both need to feel confident that we're clearly back on a path to 2% before it would be appropriate to reduce interest rates. Last week in Canada, we held our policy rate at 5%, where it's been since last summer. We did stress that we are encouraged by the recent progress we've seen on inflation, and we want to see it sustained. And just this morning, Statistics Canada published the March CPI. As expected, headline inflation came in close to 3%. We have seen gas prices in both our countries move up. Importantly, though, measures of core inflation did tick down again, and that does suggest that underlying inflationary pressures are continuing to ease. So we continue to be moving in the right direction. The other thing I want to underline is that in the conduct of monetary policy, we do spend a lot of time looking and understanding what is going on in the United States. U.S. economy has a very big impact on the Canadian economy. We also watch the U.S. economy closely, particularly through the extraordinary period we've all been through in the last few years, because the more we understand what we have in common and our differences, the better we can learn from each other's experience. And let me just close on a few words on just how integrated the Canadian-U.S. economy is. And Randy, you highlighted some of the key facts. I would totally share your perspective. I think the economic relationship really is the model for mutually beneficial open trade and investment. 77% of Canadian exports flow to the United States. And as you underlined, what less people know is that Canada is the United States' biggest export market. 17%, or as you said, almost 20% of U.S. goods head north to Canada. If you look at foreign direct investment, there is a similar two-way dynamic. In 2022, more than half of Canadian FDI went to the United States by far the largest share of our FDI. That was roughly $43 billion. In the same year, $50 billion of US FDI came to Canada. So it's a pretty balanced relationship. And I think what these numbers underline is just how close that economic relationship is and how it works in both directions. And the final thing I'll say is when you look forward, we face many of the same structural challenges. Our labor forces are aging. There's going to be a big challenge with new technology, training, and making sure we have the skilled workers our economies needs. Climate change is affecting both our economies. We're both grappling with shifting trade and investment patterns globally. Supply chains across both our countries need to build more resilience. Conflicts internationally are increasing global uncertainty. And for all these reasons, I am very glad we're having this discussion. We do have much in common. And Randy, as you underlined, when we work together, we can get a lot more done. Thank you.
Well, thanks. That's a great place to start. Chairman Powell, really interested in hearing your perspective.
Another place to start is to say, why don't you call me Jay and call Tiff?
Okay, I know I do it behind the scenes. I'll do it in front of the scenes too.
Great. So let me start by thanking Randy and Bill and Xavi and Tiff for this. It's great to be here today. I want to echo what Randy said about the mutually beneficial, respectful, great relationship we have with Canada, economically, culturally, and I'd also like to echo, I thought Tiff did a great job talking about the similarities and differences in our economy, our financial markets, the challenges we face in our policy stance. It's almost as though you somehow had a copy of that part of my remarks, Tiff. So I'm not going to repeat that, but what I will do is talk, if I could, a little bit about the U.S. economy and where we find ourselves right now. So as I think Randy pointed out, the performance of the U.S. economy over the past year has really been quite strong. We had growth of more than 3% last year as rebounding supply supported both robust growth and in spending and also employment, alongside a considerable decline in inflation. The more recent data show solid growth and continued strength in the labor market, but also a lack of further progress so far this year on returning to our 2% inflation goal. So I'll say a little bit about our two mandate goals, maximum employment and price stability. As I mentioned, the labor market remains very strong. Payroll job gains have been strong over the first quarter, averaging just a tick above 275,000 per month. The unemployment rate has been below 4% for 26 consecutive months, which hasn't happened in more than a half a century, the longest streak of its kind. Strong demand for workers has been met by a substantial increase in the workforce due both to rising labor force participation and a substantial increase in immigration, as indeed Canada has experienced as well. So even with this strength, by many measures, our labor market has been moving into better balance over the past year. The ratio of job openings to unemployed workers was extremely elevated in 2021 and 22, has now moved back down to levels just above the pre-pandemic era. Surveys of workers and businesses indicate a normalizing labor market. So do the rates of both quits and hires. And broader wage pressures also continue to moderate, albeit gradually. So the overall picture for the labor market is one of real strength, but gradual normalization. Turning to price stability, our inflation mandate. Inflation, of course, declined quite significantly over the second half of last year, over the whole year, but particularly in the second half. But 12-month core PCE inflation, which is one of the most important things we look at, is estimated to have been little changed in March over February at 2.8%, and the 3- and 6-month measures of inflation are actually above that level. So we've said at the Fomc that we'll need greater confidence that inflation is moving sustainably toward 2% before it would be appropriate to ease policy. You know, we took that cautious approach and sought that greater confidence so as not to overreact to the string of low inflation readings that we had in the second half of last year. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed. At the same time, we have significant space to ease should the labor market unexpectedly weaken. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Well, thank you. I think that's a really important frame for our discussion today. One of the things that I remarked on when I first got into public life was how often I saw my international peers as we moved around. And when I see the two of you on stage together, I know that often you see each other at G7, at G20 meetings, and I think it would be quite interesting for the audience to understand, you know, how collaboration happens or doesn't happen internationally, how central banks work together or don't work together. So, you know, maybe I could ask you, Jay, to give a perspective on how that happens from your vantage point.
Sure. So to give you an idea, we do meet quite regularly. So Tiff and I attend 2 G7 meetings per year for ministers, that's finance ministers and central bank governors. We don't attend the leaders meeting, but we attend, in the United States, but we attend the meetings with the finance ministers, which Bill was, and also 2 G20 meetings. So that's 4 meetings per year right there. We also have 6 meetings at the Bank for International Settlements in Basel. One of those is now virtual, but we're and that's only central bankers, no finance ministries. So it's all central banking stuff. And, you know, it's economics, it's financial regulation, all those things. We also come here to Washington, or every third year we go someplace else twice a year for the IMF World Bank meetings, which is kind of what everybody's doing in Washington right now. So it's a lot of meetings. What do we do at these meetings? Fair question. Essentially, the central bankers are having an ongoing conversation about what's going on in their own economies and their own financial markets, their own regulatory world with each other. And we're also talking about the big global issues of the day, as you would expect. So some of which are really the business of the elected government, not the business of the central bankers. But we have that discussion. It's more or less ongoing. We're seeing each other all the time. They're very informative, these discussions, and they really are, for me anyway, part of the way that I get to thinking about what the right policy is for the United States, is to hear what is going on around the world, what's happening globally, and how are people thinking about that. So it's very, very useful, particularly, though, given our close cultural, financial, and economic ties with Canada. Those discussions are especially fruitful and important, and I have regular conversations with Tiff. By the way, I do keep very close track of the actions of the Bank of Canada. I read Tiff's press conference transcripts carefully and pay close attention to that. Tiff did mention the similarities and differences. I'll say one more thing, which is we go to Basel, as I mentioned, 5 times a year. You're a long way from home, and we're there for 4 or 5 nights, and there are usually 1 or 2 nights off. So we go looking for someone to have dinner with, and very frequently we wind up with the Bank of Canada delegation who are really good and very funny and a lot of fun together. So we have a very close relationship with the bank and great respect for that institution, as I'll have a little more to say about lately. One other thing I'll point out, though, about our relationship is we did do, as Randy pointed out, our first review of our monetary policy framework really ever. And we looked around. The Bank of Canada also does regularly. I think it's every 4 years. In any case, we really looked to the Canadian model and other models of how to do that. We talked to people at the Bank of Canada about how their regular framework review went. So we really benefited for that. So that's what I'll stop there.
And Tiff, similar perspective from Canada?
Yes, I mean, I'll just add a little bit on as Jay outlined, certainly from my perspective, one of the best parts about this job is we do, the international community, the central banking community, it's not like a commercial bank where you're competing against the other bank. We're all in this together. And if we get it right, we all help each other. So there is a considerable openness. And, as Jay outlined, I think there's a few different functions. Yes, obviously, if you're in Canada, we have our own group at the Bank of Canada that analyzes the U.S. economy, forecasts the U.S. economy. It's very important to Canada, but the Fed's group is a lot bigger. They got a lot more experience. Hearing what the Fed has to say is incredibly valuable for us. The other thing we do, though, is it's more than just the data and the forecasting. It's thinking through the scenarios together. What risks are on your mind, Jay? What do you think could go wrong? What are the scenarios? How would we handle it if this happened, if that happened? Being able to put your heads together and think through the risks, the scenarios, the strategy. There are also a number of really, I would say, sort of behind the scenes, very central banky technical issues that nobody really thinks about except central bankers. But what are the mechanics of QE? How do you exit from QT? How many settlement balances are we going to need to? Fortunately, those are things most people don't have to worry about. They are critically important for the implementation of monetary policy. And that sort of plumbing working of the financial system, and being able to talk to people who are thinking about these things as much as you are is hugely valuable. And then the last thing I will say is, there's some things that we're only going to succeed if we do together. The obvious one would be financial supervision and regulation. Our financial systems globally are highly integrated. We were deeply reminded of this in the global financial crisis. What happens in other countries affects all of us. And money flows across borders. So, we have to do that together or it's not going to work.
Well, maybe we can drill into that for a minute. Obviously we recognize that most of your work is focused on the domestic markets, but in times of crisis, there's real challenge. As you mentioned, in the COVID period, the global financial crisis, that you were engaged with, Tiff, earlier in a different stage of your career. And for me, it was remarkable the number of interactions with counterparts around the world during those crises. So maybe a question to both of you is, what kind of interaction happens during periods of crisis? What doesn't happen? Are there things that we should be thinking about differently in order to prepare ourselves for those challenging moments and making sure that the financial system is resilient? So again, maybe over to you, Jay, to react to that and hear your thoughts.
Sure. So, our economies, our financial markets, all of our institutions are deeply intertwined. And when there is a situation where there's serious stress, you need to get a global perspective. You need to get perspective around the world. And you have to do that very quickly. And we, of course, can move quickly and effectively on the domestic front. But what the thing that you figure out in those times is that all the time you spent at Basel and at the G7 and G20 meetings, you know your colleagues, you know and trust and respect their judgment, and you don't have to go through that phase of gaining trust in people. You understand each other, you speak the same language, so there's a lot of communication. The level of communication is pretty high anyway, but during crises, it goes very high. I'm constantly talking to other central bankers around the world, and also political leaders in our government, and that sort of thing. So that happens a lot. The sense of what you're doing, again, is mostly sharing information and ideas about what to do. There may be a proposal that people are looking at, and you're talking about that. So it's very useful. I say one thing to point out is it's less about coordination than it is about talking and understanding, for one reason, or at least it was during the pandemic, and that was because almost every country's interest rates were very close to zero when the pandemic hit, and so there wasn't policy space for most economies, most central banks, to do a big coordinated rate cut. We did cut very quickly to zero, but I think we were higher than almost any other nation in terms of where our policy rate was. But anyway, there's a lot of communication, and those relationships that you built up really do help at that point. In terms of you asked about learning, what have we learned? I think that the pandemic's going to teach a whole lot of lessons over time. I still think it's too early to say what they are with confidence, and I'll point out, look, the pandemic has surprised us over and over again, most recently in the United States, the remarkably strong performance of the economy at a time when virtually all economists were expecting a recession. So I think if you'd asked for the lessons of the pandemic a year and a half ago, you'd get a very different answer. Now, I think in a year or so, we'll have a lot more answers. It is a unique set of circumstances, and we're still learning, I think, but we will try to learn those lessons. Different point, I would say, about the bank stresses, another crisis, at least here in the States. I do think we can and have learned the lessons of the stress of early last spring. And I would point to a couple things that we embraced pretty forthrightly. One was that supervision was not tightly focused on the right things, was not proactive enough, was not forceful enough. And we've tried to take steps to remedy that. I also think there will be some regulatory initiatives for banks of that size and with those characteristics in time. So I do think those are lessons that we have learned.
And from a Canadian perspective, similar lessons or different ones?
Yes, I think there are similar lessons. Maybe I'll just give a couple of other examples. First though, I will just underline, when a crisis hits, you're faced with a situation, you have to make decisions, and you have very limited information. The other reality is you have a pretty narrow window to act to be really effective. And for both those reasons, being able to speak, directly to Jay, to connect with our other colleagues, finding out what's happening in their jurisdiction, how are they thinking about it, what do they see as the options, it is hugely important in a crisis. And that it's a little more, though, than just information sharing. I mean, I think it helps us avoid unintended consequences of our actions. Sometimes you do something and it works for most parties, but not one party. And in a crisis, it's the weakest link that can take you down. So you've got to be careful. It also I think, boosts confidence in the system. If we're acting in a way that is coherent together, it boosts confidence. It looks more like a plan than a haphazard policy response. Just to give you a couple of examples, I wasn't actually governor at the start of COVID. Jay was there. But certainly looking at it from the outside, the coordinated actions of major central banks to reopen fixed income markets, providing liquidity, providing market making of last resort in scale, it reopened core functioning markets. And by all doing it essentially at the same time and all working in scale, the whole global market restarted. If that had not happened, this crisis would have been a much deeper and more severe crisis. And then the other one I'll highlight is coping with the inflation as we came out of COVID. By all being resolute in our commitment to restoring price stability, by all matching our words with forceful action, raising rates rapidly, we all helped each other. I mean, it helped reduce global inflation in goods, which was really the first part of the inflation surge, and it helped keep inflation expectations in all our countries better anchored. And I think it is a key ingredient in how we have all managed to get inflation down a long way back without causing recessions in our economies. And the last point I'll just highlight is something you said. Occasionally this coordination is very explicit. So for example, at the time of the global financial crisis, there was a coordinated G7 interest rate cut. I remember clearly because it happened at 3 o'clock in the morning in Canada, which was a little bit of a technical challenge. But most of the time, it's not explicit coordination, but it is those conversations. It is that shared information. We have similar objectives, similar goals, similar tools, and we're sharing information, and that leads to a coordinated response.
Well, maybe you could spend a little bit more time on that from the Canada-US perspective. So Randy mentioned in his opening comments the idea that when you're in Canada, you're living next to an elephant. And I think a lot of Canadians would assume that that Canadian policy has to take into account U.S. policy. So maybe could you give us a perspective into how important that is for your deliberations, and how that factors into decision making, the U.S. approach?
Well, look, I think it's pretty clear that our U.S. economic relationship is by far our most important relationship. Our economies are highly integrated. 35% of our GDP is exports, and 75% of that goes to the United States. So multiply, that's a big chunk of our GDP. Our financial markets are also very integrated. In fact, yesterday I was in New York, and when you go to New York, you are just reminded how integrated our markets are. I was at the New York Stock Exchange, and all over are cross-listed Canadian companies on many of the screens. Our financial systems are very integrated. Our banks have, most of our large banks have operations in the United States. Our pension funds are big investors in the United States. So we do spend a lot of time understanding what's going on, trying to understand what's going on in the United States and looking at the implications for Canada. There are, though, I highlighted in my opening remarks some differences. Another important difference I didn't focus on is, both our economies have big manufacturing sectors, big service sectors, large commodity sectors, but the commodity sector in the Canadian economy is quite a bit bigger than it is in the United States. Oil and gas, agriculture, forestry, mining, fishing, 40% of our exports, 13% of our GDP. And the commodity cycle can be quite different. And we have a flexible exchange rate that does help absorb the differences. And I think it's an important reason why historically sometimes our monetary policy do differ. Our cycles are often quite similar, and certainly through COVID we had a similar shock and a pretty similar cycle, and our monetary policy has been quite similar. There have been other episodes, though, where, particularly if the commodity cycle is different, you'll see monetary policy diverge somewhat from the United States. There are limits to how far it can diverge, but as I emphasized, we have our own currency, we have a flexible exchange rate, and that absorbs the differences to allow us to gear monetary policy to what we need to do in Canada.
And Jay, from your perspective, obviously the U.S. has an outsized role in the global economy, and I guess we'd be interested in understanding how much time do you deliberate on what your actions will have as reactions, and how much do you think about, what's happening with global markets as you come to your conclusions?
So I'll start by saying that each central bank serves a domestic mandate, which is, in the case of Fed, is using our tools to achieve maximum employment and price stability for the benefit of the people we serve. So it's a domestic mandate. But in the case of the United States, we fully realize and appreciate that our decisions can have significant effects on, not just on Canada, or Mexico, but on countries around the world. And that's all the more so because the dollar is the principal reserve currency, which strengthens the transmission of our policy through the global economy. So we also know that that those effects on global demand from our policy changes can have an effect on the United States as well, that can rebound to the United States. So we're very, very aware of all of that. And for one thing, we try to be very transparent and predictable, given the flow of data and events. I mean, you have to move quickly sometimes, but we do realize we have a special obligation to be predictable and transparent, and that benefits us in doing that as well. So international spillovers, of course, are an important consideration. We do track that. Ultimately, though, we think over time, the most important thing we can do to support the global economy is to deliver on our mandate of price stability and maximum employment here in the United States.
And is that, have there been changes in this current cycle that have driven any differences? I mean, you've talked about the different drivers for inflation this go around from previous periods of inflation. So do you think about it differently as you approach these things?
Yeah, well, specifically on inflation, I do think this is different. This is not simply the more standard case of overheated demand, which has been the typical thing in the post-war era for the U.S. economy and other major Western economies. There are similarities and differences, and I would characterize it this way, that the inflation that arose suddenly really in the early part of 2021 as economies reopened resulted both from constrained supply and also elevated and rechanneled demand from services to goods. So if you remember, and I'm sure will, there were unexpected widespread shortages and supply chain failures on a scale not seen in recent memory. In the U.S., several million people had left the labor force, creating a severe labor shortage that was more fully felt once the economy reopened, leading to a huge spike in wages, but also in the ratio of job openings to unemployed workers. So very unusual situation. Households had elevated levels of savings, and demand was very, very strong as well. So we thought, what's different is, have thought since we've understood the situation, that restoring price stability would require both the unwinding of the pandemic-related distortions to both supply and demand, as well as the effects of tight monetary policy on demand, which would give the supply side time and space to recover. And we think today that we're seeing those two things working together to bring that end about. And you saw that, I think, in 2023, which was really, in a large way, a supply-side story. What happened was the supply side really recovered in 2023. We thought that it would recover in 2021, and in 2022, I was beginning to lose hope. And then in 2023, you saw the shortages and the issues with the trade pipelines not fully resolved, but largely resolved. You saw the U.S. labor force shortage alleviated by both higher participation among people who had dropped out of the workforce, but also from immigration. So that was the year of the supply side recovery. And you saw the core inflation rates drop by 2 full percentage points in the face of very strong growth. So that can only be explained by the enormous increase in potential output, the supply side increase over that year. So that's how I would say it's different this time.
And Tiff, maybe you can tell us how it's different in other ways in Canada. So we were talking about the similarities and the similar approaches to dealing with inflation and the positive results. But we've seen a divergence in Canada with respect to growth. So clearly there's some differences too. Maybe can you reflect for people what those differences look like and what the ramifications are for you?
Yeah, I will focus on the differences, although I will stress, I think the main story is the similarities. And as Jay outlined, what is so unique about this whole cycle is that supply has played a much bigger role than we're used to. And from a monetary policy perspective, we don't have as good line of sight to supply as we do as demand, and we don't have any tools to influence supply. Our tools work on demand. In terms of what has been different, if you look at the Canadian economy, growth was essentially zero in the second half of last year. And what that meant was the economy, which was very overheated, supply caught up with demand. In fact, it more than caught up with demand. The economy moved into excess supply, and we're now seeing the effects of that in terms of relieving price pressure. So, why did demand slow more in Canada and the United States? I think that is a difficult question. I pointed to a couple of things in my opening remarks. I think productivity growth in the United States has been a lot stronger. You've gotten more supply than we have, so you've been able to grow more with less inflation or less inflationary pressure. And then the second thing is I think monetary policy is having more traction in Canada because the structure of our mortgage markets, half of mortgages have renewed in Canada. And even if your mortgage hasn't renewed, it's renewing in the next couple of years probably. So you're thinking ahead, thinking, oh, when it renews, I'm going to have to be paying a lot more on my mortgage every month. So maybe I should be saving more money now. So we're seeing that effect. We've had weaker consumption growth. And certainly that's been somewhat masked by the fact we've had very rapid population growth. But if you look on a per capita basis, you can see household spending per capita, per family has actually gone down, even though growth has not been negative overall. I think moving forward, we are actually seeing growth starting to pick up. The first quarter of this year looks pretty strong. We'll probably see some choppiness quarter to quarter, but overall we think that strength we're seeing in the first quarter will be sustained through the year, where we think on a quarterly basis growth is going to be averaging about 2% per quarter through this year. That's partly we're starting to see some pickup in consumption. Partly it is the resilience of the U.S. economy that is supporting our exports. They've been very resilient. And then coming back to inflation, I think those, broadly speaking, the path of inflation is pretty similar, but you are seeing, I think, some of those differences in the dynamics of the real economy in inflation. Our last few inflation readings have been reasonably good, even though total's still close to 3. Core has been, the last few times ticking down. And if you look at the more timely 3-month measures of core inflation, there is some downward momentum in underlying inflation. And I think that reflects the fact the economy is in excess supply, and that is relieving those price pressures. We're certainly looking for evidence that's going to be sustained. That's what we're looking for right now.
Well, I know that both of you realize that one of the key things we were trying to emphasize today was the importance of the Canada-U.S. relationship. And I also really appreciate all of the comments on the importance of trade to both of our economies, trade between our two countries, and foreign direct investment. And so while you're not trade policy experts, and I get that your organizations, that's not the focus, I really appreciate you giving us a little sense of, how do you think about trade in economic terms and the importance of that, and how that factors into your economic outlook. And specifically, we're thinking about the importance of the agreement between the United States, Canada, and Mexico, and wondering how you think about that in terms of its impacts on trade in general, on labor markets, on supply. So maybe I could ask you, Jay, to give us any reflections that you might have on that and deliberations impacts.
So I guess I need to start by saying we don't do trade policy. We don't really comment on trade policy other than to say that it's clear that we have a mutually beneficial, large, substantial, ongoing, healthy trade relationship with Canada that we very much welcome. Maybe I'll add one more thing, which is I want to focus on a particular export of Canada that I think somehow we just desperately need here in the United States, and we can't get enough of it. And that is Canadian comedians and comic actors. I started to count the number of really great, funny people, and I limited myself to 10. So Jim Carrey, Martin Short, John Candy, Mike Myers, Norm Macdonald, Rick Moranis, Dan Aykroyd, Catherine O'Hara, and Andrea Martin. And I could go on. So something's going on up there. The Americans love Canadian. If that's Canadian humor, we absolutely love it. So send more. We can't get enough of it.
That's a small but important part of our trading relationship, I guess. Tiff, all jokes aside,
Yeah.
any comments from your perspective?
Yeah, well, first of all, as Jay underlined, we don't set trade policy, but let me just say, try to give you more of a picture. I mean, first of all, you just look at our two countries. The east-west border is the longest border in the world, and it's a long way across Canada. So it often makes a lot more sense to trade north-south than to trade across the country. And that's really, it comes down to geography in some sense. I mean, that's fundamental to the interties we have across our countries. Many Canadians are closer to fellow Americans than they are to fellow Canadians, just the nature of the geography. You look at what are the things that we buy and sell? Well, some of the biggest things, in Canada, we buy a lot of your consumer goods in the United States. We have a very two-way relationship on motor vehicles. You buy a lot of the motor vehicles we produce. We buy a lot of cars and trucks that you produce. Similarly, energy. We're both energy producers. It often makes more sense to trade the energy north-south than to ship it across the country. So we have a very dynamic two-way energy relationship. And you look forward and you think about how much electricity the world's going to need. I expect that relationship is only going to grow. Another element that is growing quickly, and maybe that's partly comedians, is the fastest growing part of trade is trade and services. Now, if you want a haircut, you still have to do it in your own country, unless you want to go to New York to get a really fancy one. But but increasingly, a lot of services are highly tradable. The internet has completely changed how many things are delivered, and so you're seeing Canadians are increasingly importing a lot of commercial services from the United States. And then the final thing I'll say is on USMCA. Obviously, for both countries, the market access is key. The other thing I would underline, though, it's also the certainty about the market access. The certainty that American companies have that they'll have access to Canadian markets and Canadians will have access to American markets. That allows businesses to make investments, to deploy their risk capital, to commit to the future. And it's that certainty of access that is really key to building investment. I'll stop there. Thank you.
Well, I'd like to thank both of you for taking some time with all of us. I think if we had looked back a couple of years ago and reflected on what we were thinking back then might be the trajectory of our economies, we probably wouldn't have had an expectation that we would have been where we are today. We would have expected more challenges than we've faced. And I think we need to recognize that the stewardship that the Federal Reserve in the United States and the Bank of Canada in Canada have been responsible for has made an enormous difference in citizens' lives. I mean, we're in a situation that is virtually our best case scenario. So it's probably not often enough that on stage you're recognized for that important work. And I want to thank both of you for all that you're doing for all of us in making that the reality. And also I want to thank you for taking some time here. I mean, we are reflecting on the fact that in a couple of years, the U.S.-Mexico-Canadian trade agreement will be looked at again. And we want to reinforce the importance of working together, the importance of collaboration and cooperation, and really great trading relationships. So this is an important way for us to start this off, seeing the collegiality between the two of you, knowing how well people work together is really important for people. So Thank you very much. And I know it's a busy week for you, so we appreciate also taking the time during this busy week. So thank you. From the Canada Institute, I'm going to ask Xavi Delgado to close off our session today.
Thank you, Bill. That concludes today's program, everybody. Thank you all, everybody in the room and online, for joining us today. I also want to give a...
All right, guys. So I'm sitting over here eating sunflower seeds. Market really didn't react that much. Sideways. My apologies, I'm late. I was at jiu-jitsu. For whatever reason, I thought this was at 2:15 Eastern time. So I thought I had a little bit of extra time, but, that's how it goes. And the market really just kind of underreacted here. I see people arguing in chat. What did you guys think of the speech? My portfolio is pretty green relative to where it was prior to the speech. Yeah, I figure if there was any Jerome Powell speech to miss, this was the one, Not much going on. Didn't really say that much either. The Fed meeting's in a couple weeks. So, yeah, we'll see how that goes. Also, if you want to check out one of my sponsors, you want to day trade, we'll day trade for a little while here, maybe for like a second, try to trade some of this chop. If you want to day trade with me, do not put up thousands of dollars yourself, okay? It makes absolutely no sense to risk thousands of dollars day trading the market. Instead, try futures and try a funded account program in futures. What they're going to do, number one, in futures, you can day trade, have better liquidity. There's no PDT rule. I can day trade the SPY price action, the SPY chart. I can day trade the Q chart. I can day trade gold. Patterns are very similar to blue chips. If you look at NVIDIA and you look at Apple and you look at the Q and the NASDAQ are going to look very similar to Apple and NVIDIA. But you can day trade the NASDAQ 100, basically the Q price action, this chart right here, with no PDT rule. I can buy market, sell market, get in, just like stocks, but there's no PDT restriction. I'm going to take 4 contracts here and see if we can make a little bit of money real quick. Kind of a choppy thing, but we're already up hundreds on the day. We're up like $300 on the day, so I'm not going to risk too much. But again, if you want to day trade futures with me, try out Apex. Apex is the most legit proprietary funded account program. There we go. We're popping up. We're going to take a little bit more off. You can see how quickly we do this. We bought this dip, and we'll go ahead and get out the rest there. So beautiful trade here. Beautiful trade. That brings my gains on the day. Oh, we made more today than we thought. Here's my day. Kind of a whirlwind day. Gross, we made about $650, which looks about right. So about $650 gross trading futures. And again, we are trading on Apex. This is a $50,000 funded account. It just makes sense to limit your risk if you do want to day trade. There's no PDT rule. They give you a demo and they test your skill. If you could pass the test, while following their rules, they fund you between $25K up to $300K with a 90% split. And so if you get funded, you're keeping most of your profit after that as long as you can follow their rules. Anyways, so the reward is very similar to putting the money up yourself, but the risk is noticeably less. If you lose and you can't pass the challenge, the base one's 30 or 35 bucks. This one was like 40 bucks. So again, limited risk, rewards very similar. Great way to learn how to day trade. And again, if you're good enough to get funded, you can get started with a very small amount and get funded. And then once you take a couple withdrawals, then you could fund your own account if you want. And that way you can get started for less and use your trading skills to make some money. And again, most day traders lose. And so to be fair, I think most day traders will lose these accounts because most day traders lose. But it's a lot cheaper to lose this than putting up thousands yourself and losing that. And so if you want to check it out, use promo code BT, beginner trading BT. 2 letters, BT, beginner trading will always get you the max discount. There was a glitch this morning that only for the 80% off wasn't working or whatever. That is now fixed. You can get 80% off if you use my link. There's the link. If you use my promo code. I thought he was pretty hawkish. I thought it sounded like we weren't going to cut rates anytime soon is what I thought personally. Like I thought he was pretty hawkish in his tone. Like basically he was implying that we might not cut rates very soon at all. So again, I thought personally he was a little bit, hawkish. I thought it sounded like he wanted to maintain a restrictive monetary policy longer than expected, right? So if you don't know what that means, basically, it sounded like he wanted to keep interest rates high because when interest rates are high, basically he started off the speech talking about how strong the labor market was, right? And the labor market has been strong. Payroll numbers are high. Jolt's job report was high. Unemployment was low. It's been under 4% for a long time, right? And we can say, oh, those numbers are fake or whatever people want to argue because they want the economy to fail because they dislike the administration or whatever. And again, I'm not even saying I like the administration currently, but the labor market's strong. That's objectively true if you look at the data. The consequence of a strong labor market is inflation, and so inflation has been sticky. If you look at the last CPI report, PPI, PCE data, which is really one of the more preferred inflation metrics, it's been pretty low, under 3.5%, 3% in some areas. And so inflation data has been better, but some of it's also been worse. And so if we cut rates too early, basically if the Fed moves to start bringing broad interest rates down, one of the consequences and one of the disastrous effects of that can be inflation spiking. And once inflation spikes, it can get really, really sticky really, really quickly. Get your mind out the gutter. And so we'll see what happens here, chat. We'll see what happens. I don't know what's going to, what the Fed is going to do. My guess is that we're at least going to cut rates once this year. I'm not even saying I agree with that decision. I don't think we should necessarily cut rates. But I can see the Fed choosing to do that. We are ripping up right now. How am I so green? Okay, Nike, spiking up. That's nice. SoFi, spiking up. United Health, spiking up. Okay, my portfolio is looking a lot better. And again, if you want to check out Apex, here's the link. Oh, I think I posted it already. Market's got to rip it up right now, too. Look at this. And again, we've had a great day. Kind of a volatile day, but good nonetheless. We made about 650 gross. The most we were ever down was 3. So, not bad. Yeah, I mean, no offense, Shadow. I'm going to say this with all the respect in the world. But, like, you're... What does PAMP mean, bro? Are you saying we're gonna pump up and then correct? Like, again, the moves that you're saying are justifying your predictions are silly. Like, the move is like 0.5%. The market pushes up 0.5%. You're like, oh, I'm right. See, it's like, no, dude, settle down here. Okay, it's all right. It'll be all right. Hey, nice hash. Congrats, bro. Super micro semiconductors. We'll see if we dip a little bit here, chat. We'll see if we dip a little bit. Let me get this out of the way. So again, we made a little bit. It was a good day. What do you guys think? Somebody asked me if I do jujitsu. I did. We came from no-gi. You know, rolling with a girl is always kind of weird, right? I had to roll with a girl today. And I don't know what to do, right? Like, usually I'm one of those people who I go way too hard. And they're like, hey, let's flow roll. And I'm out there just kind of going like 110%. I don't try to. I just get caught up in the adrenaline, you know? I'm a spazzy white belt in jiu-jitsu. And so I'm trying not to. But I always get kind of like nervous when I roll against a female because, you know, there's a lot of like etiquette rules there. And so I don't want to just go like, I usually just end up like pulling guard and playing easy and being easy going. But yeah, it's a weird situation. I've never really rolled with a female before, so I don't know what I'm supposed to do. Can you cover Bitcoin? Isn't Bitcoin down a bunch today? Oh, Bitcoin's actually flat on the day. Dipped a lot yesterday. Oh, I mean... Yeah, I don't know, Hash. Yeah, Bitcoin's completely flat on the day. It's right around 63,000. Microsoft and other tech stocks are starting to pull back. This looks like a bullish move. Look, I'm going to go ahead and take the position here. We got 3 contracts. I don't want to hold this very long. And I'm very close to cutting this position. But now we bounced all the way back up here. It's kind of volatile time right now. I don't know what to do. We're trying to keep it easy and light, but 3 contracts is kind of moving a lot. I don't know. I'm going to limit my risk and cut half of this, a little bit more, and then, you know. Yeah, it looks like it was the right move. We ended up losing like another 60 or 70 bucks just now. I mean, we're still very green on the day. What happened to the tunes? I got started late. Again, I truly thought Powell's conference today was at 2:15. You know, so like I got started really late. Like by the time I started this stream today, it's just late. You know, I'm late. My bad. It wasn't really a huge stream anyway, but yeah. All right, guys. I'm going to go ahead and rest. Tomorrow we have nothing going on. Absolutely nothing. It's a completely boring day. Let me see if we have earnings. All right, so we got United Airlines earnings this evening. IB, Interactive Brokers. Nothing tomorrow. Thursday, we got Netflix earnings, jobless claims numbers, durable good orders, I believe, and some other stuff. And then Taiwan Semiconductor Manufacturing Company drops earnings Thursday morning. But again, it's a pretty boring week. Outside of this today, jobless claims and durable good orders. Thursday, economic data is pretty light tomorrow. We don't have anything except for maybe like mortgage rates. We got European CPI data coming out. But even the market's kind of chopping back and forth. And then Friday we have nothing. It's a boring week. Next week's very busy. We've got next week we have, let me put this up. Next week we got services and manufacturing PMI on Tuesday. Wednesday, durable good orders. Thursday, GDP data. Friday, PCE data. So inflation data, a big inflation report next week. Very big. And then I think the week after that, we have non-farm payrolls, unemployment, non-farm employment change report, earnings. Next week, we also have Tesla earnings. Really the biggest earnings start next week, which are tech stocks. So tech stock drops earnings next week. And then, yeah, we just got a lot of stuff coming. And so, yeah, CB consumer confidence. Yeah, just a lot of stuff happening, chat. So, yeah, I'm going to go ahead and get out of here. Y'all be good. Again, if you want to check out Apex, day trade with me. Again, we had a pretty good day, all things considered. Kind of volatile day, but pretty good nonetheless here. This chart's kind of weird. Some of the rhythmic charts take a little while to update. But here's our graph today. Basically, we ended gross up about 670s. So I'll take it. Pretty good day. If you want to day trade with me on Apex, again, use promo code BT Beginner Trading. They give you a demo. They test your skill. Most day traders lose, and so you should really limit your risk in the beginning by using something like this. And again, you'll probably lose at least one of these accounts, but it's a lot cheaper to lose this than to put up 5K and lose that. And that's what most traders do. They put up 5K, they lose it. That's what I did. That's what most day traders do. You can still day trade essentially the SPY, essentially the Q, no PDT in futures, day trade short, all that good stuff. And again, there's no PDT rule in futures. Also, understand CFTC 4.41, all that good stuff with these funded account programs, hypothetical or simulated performance results. Also, remember, I have no idea what I'm talking about, and I'm wildly wrong about everything. Good luck, guys. I'll be safe. Again, if you want to check out Apex and trade with me, not a bad day. We're up like 500 plus on the day. Pretty good day, all things considered. Check out promo code BT. Yeah, this isn't CFDs. All right, guys. I'll see you guys later. Y'all be good. We'll see you guys tomorrow.